Now we are all trying to time the crypto market somewhat, right? And Bitcoin is leading the pack. We're trying to find out, is Bitcoin going up? Is it going down? When should we be buying? When should we be selling? And nobody, of course, has a perfect answer to this. But what we can do is we can do backtesting. So we can look at different indicators, such as, for example, the simple moving average. That's here, this blue line over here. And we can simulate buying, for example, when the price is above the moving average. And we could simulate selling or maybe even betting on falling prices. And the price is below the simple moving average. So that's a pretty standard strategy. And we can try to backtest this. What kind of moving averages work? How should we approach this? What's actually happening depending on the trading fees that are incorporated. Now what we see over here on this chart is in green the backtesting result. So this is what we would have gotten if we followed either buying Bitcoin at certain points in times or alternatively betting on falling prices during other times. Now this is a linear scale and this is a very, very long-term chart, right? Starting in 2010. So instead of looking at this here on a linear scale, we should swap this to a logarithmic scale. And this is usually what most people see in these long-term Bitcoin charts, right? In white, we see the Bitcoin price and we see our bull markets and our crypto winters and bear markets. We see how this always goes in cycles. And currently, we are maybe finishing up our current bear market. And in green, we see the same thing, the backtesting result. So this chart and this chart pretty much shows the same thing. The only difference is here the scale on the left, on the y-axis. Now what's nice about this chart is we can see actually how this performs over the long term. We can see that the outperformance isn't hyper consistent, but what we can observe is, and this I think is the most important thing here, is the bear markets, they aren't as massive for the backtested portfolio. Here, look at this, right? When we see these drops here are more than 90% drops because one horizontal line to the next is either from bottom to top a 10x or from top to bottom a minus 90%, right? So when this drops by roughly one of those horizontal units, we've got a 90% drop. We see on the white line this happened several times, right? This is here the very first collapse. And then we've got here the Mt. Gox and Silk Road collapse, also roughly 90%. Then here 2018, the ICO crash, and now currently the current sell-off from 69 to currently 16K or so, right? So we see these massive crashes on the white line, but when we look at the green line, first of all, in pretty much all of the times we've got an outperformance. The green line is pretty much all of the time above the white line. We also see the crashes aren't as massive. There are still corrections. It's not always just going straight up, but we can see when things go down, we are somewhat protected. And sometimes we are even making money from these capitulation events because we are going short, right? For example, here, look at this 50% crash that happened from roughly 7 to 3.5Ks, right? The final minor capitulation in 2018. We made money during this time. Then when it goes sideways, we usually lose money. Currently, we are also rather losing money than making money because there is no real trend in here. So the strategy is not perfect, but still over the long term, the crashes, the corrections, they aren't as pronounced. And so we could take advantage of this in two ways, right? We could either simply just allocate more money to this strategy instead of just buying raw Bitcoin, where we then have to worry about potentially losing 90%. We could manage our risk and thus allocate more capital and sleep relatively well with this. Or alternatively, and this is a bit more advanced and also to be taken a bit with a grain of salt, we could potentially slightly lever this up as well, right? So we could maybe put in a 0.2, 0.4x leverage on this and then even increase the performance more, thus mimicking the risk profile, maybe still go down during bad times by like 80-90%, but overall, because of the leverage, we would be outperforming even more, right? So having less volatility while similar returns, or in this case, even quite nice outperformance, is a good thing. So not just the outperformance is great here, the lower volatility, the lower drawdowns is the main thing. So even though this chart here looks very impressive, and if we followed this, we would now be at an $800,000 portfolio if we bought one Bitcoin here, right? If we traded with one Bitcoin and then went in and out of the market, we would now be at 800,000 instead of 16,000. This delta is of course significant, but it's not the delta that I think is most important or is most impressive. What I think is more impressive is simply how we protect ourselves from the bear markets. Now, how does this all work? This works with the moving averages, right? So as explained, we want to be betting on falling prices when the price is below the moving average, and we want to be betting on rising prices when the price is above. Now, the question with this is, what's the ideal duration of that moving average? And I'm getting a bit here ahead of myself. You can already see what I've entered here. 43 is actually the best moving average, but we could, in theory, take a shorter moving average and go in the market earlier and exit the market earlier, thus taking more of the bull and bear markets, but also have more failed signals. Or we could expand this and maybe take, say, the 50-day moving average, have less failed signals. But then also, when we are crashing, we might be getting back long at a relatively late point in time, right? So we are less reactive to either direction. Here during the Corona crash, we can see this relatively well. So a 50-day moving average, we would only enter the market after we've already rallied 43%, right? And we would only go short once we have already fallen by 11%. But if we are shorter on the moving average, let's say we have a 25-day moving average, then you would be entering way earlier already, right? After only a 34% rally. So this is kind of like the trade-off that we need to do. What's the ideal duration? The shorter it is, the more we go in and out in sideways movements and just create trading fees and potentially go down in performance. And the longer we are, the more we protect against that. But on the other hand, we also might potentially switch too late. So I've done this backtest in two ways, or in two time frames. The first time frame is this one over here, right? The entire Bitcoin history. Now, one might argue that Bitcoin traded quite differently in 2010 than it did, say, in 2020. And so because the size of the market has increased, the number of players have increased, maybe the way it's traded has also changed. So what I also backtested on top of this is a different duration, which starts in 2017. So over here, we've got a bit of the 2017 ICO rally still. We also have the 2018 crash, of course, then the whole recovery, and then our current crash. So we see if we only take 2017, also a relatively consistent outperformance, also with less crashes from top to bottom. So kind of like the same performance picture. Now, what's most important here, and this is now the most complex of the charts, is, as mentioned, what kind of a duration should we actually take? And I've not just backtested Bitcoin here, I've also backtested, say, the altcoin market with total 3. I like to look at that. That's to be found at the premium membership. You can find that in the bottom. But let's look at Bitcoin first. So let's look at this backtest. And I've not just checked the 44-day simple moving average. I've actually checked all the moving averages from 1 day, basically just looking at what happened yesterday. Should we just go long or short based on what yesterday happened? So I looked at 1 day, 2 day, 3 day. These are all simple moving averages here on the x-axis all the way to the 52-day. And on the y-axis, we've got the annualized performance. So every year during this entire holding period, what would we have gotten on average with Bitcoin? You can see here, if we just bought and held Bitcoin over the entire time, we would have gotten 180% per annum. And that's here also indicated by this black line, the HODL line. Okay, so you just bought and held. And the first interesting observation here is, of course, that the best moving average in terms of duration is the 44-day simple moving average. Okay, so this is over the entirety of Bitcoin's history. So if we enter here length of 44 days for the simple moving average, this is what worked the best over all of Bitcoin's entire lifetime, which, by the way, we are currently below that moving average, so you'd still be bearish. We are short currently. We are not yet buying in. Notice how we do get our fake outs. So the strategy is obviously not perfect. It's simply just what worked best in the past. That's the 44-day. What I also find interesting is if we are not too short on the duration, so when the duration is longer than, say, 21 days, then we tend to outperform with pretty much any moving average compared to buying and holding, even if we include the trading fees, right? So I entered 0.2% each time when we buy and each time when we sell. So for a swap from getting long to short, I actually entered 0.4% of trading fees. So there are pretty significant trading fees here that you can realize just with decentralized finance, right? So you don't have to necessarily put your funds in Binance and any centralized exchange and reduce the trading fees this way, but this way also have the centralized risk. You can achieve 0.2% trading fees with DEXs if you are careful what DEX to use. So you can still keep your self-custody, and if you've got a duration of your simple moving average above 21, should be relatively good to go. Now the best is of course 44 days as mentioned, but you don't have to necessarily take that, right? Any kind of moving average that's, let's say, is above 30 or 31 or so tends to be doing comparatively well. So this is, I think, a pretty interesting finding. You don't want to be trading too actively because then the trading fees might eat you up, and the more active you trade, the worse it gets. But you do want to somewhat react to the momentum. You do want to follow the trend somewhat. If you do, and you don't make this too actively, you tend to still outperform buying and holding. And of course, you tend to reduce your risk, your downside risk, right? So when things tend to go down, don't be afraid to open a short position or at least exit the market. It tends to preserve the capital relatively well. Now, you might say, okay, thank you for telling me this now, right? We've already seen so much of a drop. Shouldn't we now just keep buying? Well, it depends, right? You want to follow these moving averages, and currently we are still below, so you would not yet be buying. I'm not presenting this idea, the strategy, for the very first time on this channel. I think actually the very first video on this channel was about this moving average following strategy, and over the, I think, 1.5 years or so since this channel is running, I have not actually changed my position on this. I think this is still a pretty valid way to follow the movements of Bitcoin and of the crypto market in general. For total 3, as in for trading altcoins, it even works better. The outperformance is even more impressive. The downside protection is even nicer. But as said, for those results, I keep this for the premium members. Now let's go to the recent past, because this is all of Bitcoin's history. And as mentioned, trading now is vastly different in terms of dynamics, at least one might expect, in, say, the last 3, 4, 5 years compared to the entire history where Bitcoin was just a few cents, right? So let's compare the best moving averages over the entirety of Bitcoin's lifetime to only this time frame, beginning here in October of 2017, the last part of the bull run. Okay, so we've got 2 crypto winters here basically in, and let's look at what here the best moving averages are. And this is the result. And I find this very, very encouraging. Let me toggle between those 2 charts actually. So here we've got all of Bitcoin's history. Here we've got only since 2017, October of 2017. What I find very encouraging here are 2 things. The first thing I find very encouraging is what's actually the best moving average. It's the 44 for the entirety of Bitcoin's history. It's the 43 for just the last 4 or 5 years. So the kind of approach you take seems to have not changed too much. You can take the same kind of moving average no matter if you look at all of Bitcoin's history or only at the last few years. So the dynamics really haven't changed too much. What I find even more encouraging is the strategy tends to be working even better in the recent 4 or 5 years than it did at the beginning. Because look at buying and holding. Buying and holding didn't work too well since the beginning of this measurement, right? It's quote unquote only 30% per annum, right? Let's look at this chart again. We started here in 2017 and we had our first crypto winter, we had our recovery, our second winter. This delta here, how we are growing from this point to this point, is not that massive. It's 30% per annum. It's still nice compared to traditional finance, but Bitcoin is obviously more risky. 30% per annum isn't super impressive, right? This is what this black line here is showing. But look at how many of those moving averages actually outperform buying and holding, and also by what kind of a delta they outperform. So first of all, if we are only above, say, the 12-day moving average, we also tend to outperform. The delta here is massive. 30% for buying and holding, but more than 100% each year per annum for this 43-day moving average. And when we look at this on a linear scale, this is how that actually looks like, right? Bitcoin here basically almost looks like a gambling, very poorly performing asset. This is still 30% per annum, but this is very, very low on this chart compared to this performance of following that moving average and including those 0.4% swapping from long to short. So super, super impressive in my opinion. The strategy tends to work better with time. Markets seem to even work more with momentum now than they used to, which I think makes kind of sense because now people look at these long-term charts and things might become somewhat of a self-fulfilling prophecy, right? People look at what kind of points in time has Bitcoin bottomed in the future, in the past, at what points in time, say with logarithmic regressions or with realized values, etc., should we rather sell? So there is now more history and everybody looks at the same thing. And when everybody expects Bitcoin to bottom, then this will fulfill itself because everybody is buying, right? So when there are enough people that believe in a bottoming, the bottom will come logically, right? Because nobody's selling and everybody's accumulating. So this is probably why following the momentum now works even better than it did in the early past. The reason why I say it works even better is because most of those moving averages are now above buying and holding, and they are above it by way, way more of a delta, right? 30% per annum versus a doubling every year. So I really, really like this strategy. I really, really like following this. And as said, this is not perfect. We do get our fake outs. So for example, in this particular case, right, we would have bought here on the 12th of September just in order to then sell the next day. And we would have lost like 10% in a single day. So this is also included in this backtest, right? You would be selling. You do nothing all the time. You buy here, you sell here, and then you go short. You go short all this time just in order to then go long again after a 1% increase, just in order to then go short again over here, right? You're long during this decline. So these fake outs, they actually do cost quite a bit of money and they are frustrating because there are quite a few of those fake outs. But the strategy still works because in those cases where we don't get fake outs, where we actually do create a new trend, the profitable trades are massively profitable, right? When you are short, when the market drops by 47%, you're really making quite a bit of gains. And so most trades here do generate losses, but the few ones that do make gains, they are way larger in size. And this then leads to this long-term outperformance. So when the market just goes sideways, the profitability of the strategy isn't too great, but when we have some kind of a trend, we do tend to outperform. So this is why I like this, and I simply just wanted to show this again. If you are timing the market with Bitcoin, take the 44, or in my case, I take the 43, it's more recent. Take the 43-day simple moving average, so you can simply just go to tradingview.com and then press / and enter moving average, right? You add this to the chart, you double click on the line, and then if you want to, you can change the styling to make this a bit more visible. And then in inputs, you enter 43. Make sure when you do this that you also change the tick size over here, right? Make sure that this is day. Otherwise you get the 43 hour or 43 week or whatever your tick size is. As a average, you want to get the day average. And the backtest, by the way, has been made just as that you buy when UTC midnight is above or below. So we don't trade these intraday movements where you go above and below the moving average within the day. We only look at the price at midnight UTC, and then we buy whenever the price is below, and we go short whenever the price is, the other way around. We buy when the price is above, and we go short whenever the price is below the moving average. That's the idea. Now, following this in practicality is harder than it seems. You could, in theory, automate this, but then very often, if you don't do this with your own code, if you do this with a centralized exchange, again, you're exposed to centralized exchange risk, then it's hard to allocate a lot of money. To do this in a decentralized way isn't that simple, but I'm also working on such a script to make this happen as well, writing a bot that does this automatically. There are alerts in the premium channel that show whenever these moving averages get crossed. So at least then you don't have to look at this every single day. There's also daily market updates, by the way. So yeah, that's it for the new backtested Bitcoin simple moving average. I've also backtested, by the way, the exponential moving average and the double exponential moving average and all kinds of other approaches. Those tend to not work as well. I've done this for several assets, etc. It's really keep it simple, stupid, make it as easy as possible. And the simple moving average, the SMA, really tends to work the best when running all of these backtests, no matter what kind of asset we take. So that's what I recommend. That's how I personally approach this. I will be buying again. I will be DCAing again once we cross the moving average again, which could happen in the next few days. Until then, I still continue to be somewhat cautious, right? Who knows if the FTX fallout will show us even more negativity, but it also could go the other way around, right? If the Fed really does pivot soon, then this could also create quite a bit of a rally in traditional markets, which could then spill over to Bitcoin. So I just follow the data. I just follow the charts. I follow the backtests. They have been working in the past. They are free of emotions, and controlling emotions is also one of the main things in timing the market, right? It's very hard to go against the emotions. When things go up, you want to keep holding. You don't feel like selling. Things go down. You don't feel like buying because it just continues to go down all the way. So this is one approach to handle those emotions. Hope you found this useful. If yes, then please give this a thumbs up. It will help the channel grow. Thanks for watching and see you in the next video. Bye-bye.